Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, September 20th, 2022. Starting with markets, we have stocks down this morning, commodities up, crypto down, dollar up, global bond yields up, market moving headlines. So the global liquidity cycle downturn continues. Sweden's Riksbank surprised with a 100 basis point rate hike and said more increases are ahead. The move helped boost speculation. The Fed will raise by a similar magnitude tomorrow, although I don't think that is the case. By contrast, the PBOC paused its easing, though economists still expect to cut in the coming months. No cut for you. We talked about that in lead-off morning note the last few weeks about this, the Chinese yuan getting to the psychologically important 7 handle, which has caused the PBOC to slow down its pace of easing and shift to a neutral monetary policy stance. Obviously, that's not great from in terms of the outlook for Chinese growth. So the pair of moves marks a busy start for a busy week for central banks. Within one 24-hour period, there will be more than a dozen rate decisions, including from the U.S., U.K., Brazil, Turkey, Japan, Switzerland, and Norway. Again, we talked about this a couple of days ago, but 500 basis points of rate hikes expected in this week alone from the global central banks. Obviously not great for the growth outlook in 2023, which I think we'll start to think about a little bit more seriously as we progress through Q4. Stop plotting ways to fight the Fed and get some exercise instead. That's my, I'm your friend here. I'm trying to help you. I think a lot of investors are just banging their head trying to fight the Fed, and it's just not working this year. So 2-year yields are poised to crack above 4%. For the first time since 2007. Where were you in 2007? That's a flash blast from the past. The yield on the benchmark short end was 3.97% today, up more than 320 basis points a year and headed for the biggest annual increase since 1994. Where were you in 94? 94 is a good year. Is that? I think Illmatic came out in 94. It was a great album. A lot of stuff going on back then, but it's a long time ago in terms of how tight this Federal Reserve is, and very clearly we've shifted to a new monetary policy regime. It's not clear to me that investors are fully aware of that and fully bought into that. We keep seeing investors, try to buy the short end, thinking the recession views here, try to buy the long end, thinking the recession views here, and it just continues to be a grind higher for both rates, short rates, and long rates. As the world continues to realize that, hey, who is left to buy these debt securities with the Fed and ECB, Bank of Japan, Bank of England, et cetera, Chinese PBOC, all shrinking their balance sheet in dollar terms. Shifting gears again. On the contrary, hedge funds continue to content to fight the Fed to some degree, are grossing back up. So hedge funds boosted both bullish and bearish positions at the fastest rate in 5 years, amid the worst equity sell-off since June. This is going back to last week. The S&P 500 plunged more than 5% last week, and funds snapped up single stocks while betting against broad market products like ETFs, according to Goldman's prime brokerage data. Goldman's prime brokerage is not the only prime brokerage. There's obviously many others across Wall Street. It's just one microcosm of some of the action that we saw in one particular prime brokerage house. But it is indicative, and this is something that I think they were talking about on the Market Huddle this past week with the Cuppy and the guys, and they were saying, hey, look, investors are going to start to try to make back their year heading into Q4 when they know they're going to get redemptions anyway from having a bad year. So they're going to start taking shots on net, trying to generate returns either bullish or bearishly. And so you're going to see gross exposure increase. That's dangerous in the context of what continues to be aggressive selling of skew. One thing we track in our crowding analysis on a daily basis, that tool is designed to generate short-term actionable trading ideas for 42 macro subscribers. But one thing we've consistently called out in recent weeks is the aggressive selling of put skew to fund, partially now it's to fund some short-dated vol exposure. If we get into a situation where investors get shocked or fearful for any reason, they're going to, they're going to reach for put skew. This underweight in put skew is going to cause investors to really start to catalyze a real negative gamma experience amongst market participants. So that's not something that, it's hard to predict exactly when or if that is going to happen, but we do believe amid phase 5 being this sort of broad acceptance phase of the global liquidity cycle downturn, that bad news is bad news. And that if we get any incremental bad news on the growth front, which our grid model is suggesting is going to be a mid to late Q4 event, that's when you can start to see that rush for put skew, that, that negative convexity, that negative gamma environment really start to reemerge again. And that's probably when you may retest the lows, if not go through them. But between now and then, just the path of least resistance is obviously down with the net liquidity function being what it is. Big movers, Bitcoin down 2% minus 8% month over month. 10-year German bond yield plus 12 basis points to 1.93%. That's up 70 basis points month over month. 10-year UK gilt yield plus 16 basis points to 3.29%. That is up 88 basis points month over month. Don't fight the Fed. Don't fight the Bank of England. Don't fight the ECB. Bonds are a sell. Real rates are on the rise because, again, there is a supply-demand imbalance for debt securities globally. Anyway, getting to our volatility-adjusted risk management, volatility-adjusted momentum signals and probable ranges. Bullish VAMS dollar in the middle of the range there. Gold bearish VAMS middle of the range. 10-year nominal treasury bullish VAMS getting towards the upper boundary of the probable range with 6 basis points to go there. High yield credit spreads bullish VAMS middle of the range. S&P 500 neutral VAMS middle of the range. VIX bearish VAMS got about 5% upside, 22% downside there. NASDAQ 100 neutral VAMS middle of the range. Russell 2000 neutral VAMS middle of the range. Bitcoin bearish VAMS middle of the range. Ethereum bearish VAMS, you get about 3% of downside, 23% of upside there. Neutral VAMS, Shanghai Composite, that's oversold. Bearish VAMS, WTI, that's in the middle of the range. Ag, bearish VAMS, not quite in the middle of the range, but got about 2% upside. Industrial metals, bearish VAMS, got about 1% upside to the upper boundary to the proper range there. So with that, Darius Dale presenting our macro minute for Tuesday, September 20th, 2022. Best of luck out there today, and hit subscribe and like button if you like what you're seeing here. We appreciate all the support. Thank you.